last 10 years, inflation has been higher than interest rates because we had crazy low interest rates. However, I said, okay, well, ignoring the last 10 years, what was it? Like, what did it look like? And it's predominantly the interest rate is higher than the CPI or the inflation print that comes out.
It should. Do you mean that the other way around? Isn't inflation higher than CPI?
You would actually be surprised. So I'm looking here. We
need like a Jamie from like the Rogan podcast, where it's like bring the chart up, or Duncan from the compound.
So some of the data that I could get out of Australia wasn't huge. Trying to like slide it across itself. So I actually looked at the US on going back to like the 1950s, and the funds rate was significantly higher than the inflation rate for majority. Like I'm talking 60-70% higher. And I got to do better charting for these, but I was looking at this. I'm like, it is more often than not a positive real interest rate than a negative real interest rate.
Wow, so this really is a very unique time in history we're going from there.
And it was the same in the States. So if you go back over the last 10 years, same. So inflation was higher than interest rates, same as us, right? But this is just a unique time. If you go back to like the 1950s to about 2000, like the interest rate is significantly higher than inflation.
And it should be, to be clear, because if you're in the business of lending money, if you're a bank and you're lending money out, you'll be losing money on or losing purchasing power, to be specific on that. So for private lenders, what a difficult environment. If you're lending money out at 5% and it's being eroded away, well, you have to find other things. This is one of the reasons why I think in the last, we'll call it 10 years or whatever, a super low interest rate environment, it's been very difficult for people that are into things like bonds to get a return because of what is going on there. Again, I can't speak for the specifics of bonds. I won't pretend I know a lot there, but that's what I've heard on other avenues. But bringing this back to the topic at hand, Ground, like, knowing that we're in this, has this changed your view on how to invest or how you're thinking about investing in property if your awareness to the function of debt has changed here?
It's a great question. So the short answer is no. So the reason I went back and looked at this data is I'm like, where are we sitting in this? Are we the norm? Like, is this the norm now? Like, have we just hit like negative real interest rates is just the norm and this is it? Now when I went and looked over history after the last 10 years, I'm like, okay, that's the difference is interest rates are usually higher than inflation. So it's usually a positive real interest rates and property prices have gone up. As your nan story when she bought back, sort of looking at this data, I'm like, there's no huge correlation between the two. So when I look at it, I'm like, well, I'm just happy that the debt that I have on the investments that I own is being inflated away at a higher rate. However, I look at that more from the inflation, like the rate of inflation, which is 7%, as opposed to it being a negative real interest rate. I just look at it going, wow, okay, what are the banks going to do to respond to this? So overall, like, it doesn't change too much for me. I'm still going to be buying. Even if it went to a positive real interest rate, I'm still going to be buying. Like, I'm not too worried about it. What about you?
It's actually changed a lot for me, and I'll express some things here. Across this year, I have raised my cash reserves in line with interest rates going up. So one of the things I've done to combat the impacts of interest rates on my portfolio has actually lowered my debt level, my LVR. Now, I still have debt. I'm not saying that I have zero debt, but I've actually changed the amount of debt I've had. And what has hit me is like, I've done that as a defense mechanism to make sure that I can ride out potentially more volatile time. I don't know what's going to happen, but I wanted to be prepared for anything. Now, in doing that, it's improved the cash flow on the portfolio. So paid down some debt, making more cash flow on the portfolio. However, I'm inflating away less debt. I had been looking through it in one lens. So, I mean, it's not the worst problem in the world, but I realized that, hang on, if I'm now using my cash and paying down debt, perceivably, like, that improves the cash flow on the portfolio. However, the cash flow I'm now producing on the portfolio, I got to pay tax on. So more profit in the portfolio has meant more tax. And also those dollars I'm earning are being inflated away. So I think there's this really interesting balance to strike between you could literally, in my case, and again, I look at this and go, if I paid off all my property and had no debt, I would lose the ability to use inflation as a tool to actually build wealth through purchasing power. So I am really struck by the idea that there's almost like this balance to play. It's like I want enough debt so that I'm utilizing inflation in a way that is meaningful for me and my personal circumstances, not financial advice. But then on the other hand, I don't want too much debt where maintaining the cash required to run that portfolio goes negative. Because it'll be easy to say like, oh, negative real interest rates, borrow as much as you can, Grant. Like, well, if you could make a 2% spread on the debt, why wouldn't you? But then you now need to think about this through the lens of going, well, if I take on too much debt and markets turn or I have vacancies or whatever would happen where I can't actually handle the portfolio, well, then you could end up in a very desperate position of having to sell assets, forced sale of assets. You have to sell something to make good on your debt. And in every circumstance I've read about, when someone has to force sell assets, that's when they take the real losses.
Totally.
So they take the heavy losses.
I actually ran a scenario in my mind to see the correlation between like the real interest rate figure compared to my decisions. And so what I said, so the current real interest rate is like -2. And so what I did was I said, okay, well, how can I make it -2? Well, I can have 1% interest rate minus 3% inflation, -2. Or I can have 10% interest rate minus 12% inflation, which is, again, -2. And then in my mind, I'm like, through those 3 scenarios, would I still play it the same? So my question to you, Charlie, is imagine interest rates was 1% and inflation was 3%, so -2, versus interest rates were 10%, inflation was 12%, which equals -2. Would you play those 2 environments the same way?
That's a really well thought out question. I wish you'd have told me it before the podcast so I could put some more thought into it.
Dude, for me, the answer was yes. I'm like dead set. I would play those 2 situations completely. My borrowing capacity is going to be fundamentally different when interest rates are lower. I'm going to be able to borrow more because obviously the government wants me to get more things. Inflation is at a steady state, right? And I'm like, I'm in a less volatile market. However, in the other one, 10% interest rates minus 12% inflation. I'm like, dude, that inflation is scary as hell. And not to mention, the government doesn't want me borrowing anything. However, it's still a -2 real interest rate. And so I'm like, the real important one for me is not the -2. The -2 is a great trend indicator. It is more, what's the interest rates doing and what's inflation doing?
I feel like this is one of those things where it's like, where they talk about, well, of course, you should just buy all the assets when it's like the absolute bottom of the market. Like logically, that makes sense. But then emotionally, that's not what happens. So most people panic, do you know what I mean? So I'm sitting here and I'm trying to be honest with myself because this has been interesting. Like I have a substantial amount of debt, a very substantial amount of debt. I also have a substantial amount of equity. So in the means of being transparent here is like I have like, I'm going to say over 4 million debt. That's a large amount of debt. Now, my LVR position is healthy and like I'm in a good place, but I would be lying to say that having 4 mil of debt when an interest rate goes up doesn't affect me more than if it was $1 million in debt.
See what I mean?
So completely. Size of the portfolio even goes into this in a deeper level than just, hey, like how would you play it? Or, would you be able to do it the same? Your stage of investor came out as well. Now, in your suggestion here, I would make the argument that the 10% environment would probably be when you could buy better assets because there would be more nervous hands.
Because not
then the 1% probably booming market, and you could overpay or buy a dud asset.
See, but this is where like these figures and where everyone's like, oh my gosh, like inflation's going crazy. Oh my gosh, interest rates are going up. It doesn't like it's like your situation. It's like how you interpret it. It's how you will change it. But I just found it fascinating. It was an awesome thought exercise. All right, fellow property investor. If you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.